Thanks. My name is Kallir. I am the CIO of HGC and the portfolio manager of the HGC Arbitrage Fund, which is a fund we're going to talk about today. Going back, HGC is 5 years old. We launched in June 2013. And when we launched, we really thought that alternatives were moving away from the super fund style hedge fund, do anything type hedge fund. We thought it was moving more towards a more strict, narrow mandated hedge fund. And that's what we tried to create here with HGC. And that was really the genesis of the arbitrage fund. So inside the arbitrage fund, we run three main strategies. The first is definitive merger arb, which is really capturing a spread around a definitive merger arb transaction. There's always going to be a spread between what the company is ultimately going to get bought at and what the stock is trading at. That's there for two main reasons. The first, there's time value of money. The second, there's going to be some underlying deal risk. So we look to capture that spread. The second strategy we run, subscription receipt arbitrage. So a subscription receipt, it's a form of contingent equity. It's issued by a company looking to make an acquisition, maybe an asset acquisition or a total corporate acquisition. So when they issue this contingent equity, it actually trades on the exchange, typically a dot. We're going to look to buy that sub-receipt, short the common stock, collapse that spread when the underlying transaction closes. The third strategy, and what we're actually going to spend most of the time on today, is SPAC arbitrage. SPAC is a special purpose acquisition corp, and there's many different arbitrage opportunities available when you trade around this product, and that's what we're going to get into a lot later. I should have, flipped that over. So a little bit about the fund. The fund has a 4.5-year track record now, actually coming up on 5. Something we're very proud of, 3 down months, and our maximum drawdown has been 59 basis points. The main goal of the fund, we view our first job really to protect capital. That's the most important part to generate a long-term, attractive annualized return. The worst thing you can do when you're trying to build wealth is have a drawdown. You know, the simple math, if you lose 10, you need to make 11 to get back to whole. So everything we do is revolved around protecting capital. Given to that, our downside focus, that's how we size our positions. So we don't size our positions looking to make a certain rate of return. We size them based on how much we're willing to lose. We're going to be talking about the interest rate environment on the panel section. We think we have a very high correlation, almost a 100% correlation to a rise in interest rates. Every 3 strategies we invest in, it's really a risk-free plus type risk strategy. And with such a short duration, it's very easy to pick up that increase in the risk-free rate. And over time, we think we can return 6 to 8% over a 5-year period net to our investors. So conceptually, we're going to talk about SPACs today. We think the concept of a SPAC and how we trade a SPAC really defines HGC and what we're trying to do as a firm, and certainly what we're trying to do inside the arbitrage fund. So I'll give a little bit of a primer on the vehicle. I'm not sure how familiar people are with the vehicle. But effectively what a SPAC is, it's a special purpose acquisition corp. So a sponsor will get together with a management team, and they're going to go and raise what's effectively a blank check company. So they're going to come to the market, IPO, and look to find an acquisition. Typically, they'll have 12 to 27 months to go and find that acquisition. Couple important points to note. When you invest in the IPO, that money is then directly placed into a trust account. The management team has no access to those funds until they come and announce a qualifying transaction. So during this course of the SPAC, they have actually no access to that fund that's sitting in a trust account. So again, they'll go look for a transaction. Upon finding a transaction from, in their 24-month time period, they then bring that transaction to shareholders. As a shareholder, you have 2 real options. 1, maintain your ownership in the SPAC, carry on in an operating company, or 2, redeem your pro rata share of that trust account, which is typically going to be $10 plus some sort of accrued interest. But with this structure, as I said, there's a lot of different unique opportunities. One of the things that we really like, you actually get a free look at the transaction they come with. So the decision on whether you're going to sell or whether you're going to redeem actually becomes very, very easy. You're going to have a 3 to 4 month market check between when they actually announce a transaction and when you have to make the decision. So between announcement, they have to file the proxy, they have to go and get a shareholder vote. There's a number of different steps. So from our point of view, it makes our decision very easy. We're in this trade purely as an arbitrage. So right off the bat, we're not going to own this company once there's no redemption put at $10. So either there's two options. One, if the stock trades above $10, we're going to look to sell that stock before the redemption. If it's trading below $10, we're going to look to redeem and get our pro rata portion of the trust account. Two really, really important points of this that we should know. One, that trust account, it's invested in 90-day treasuries. So while you're waiting for them to come with an acquisition, the proceeds in the trust account are earning a 90-day treasury rate, which is about 2% right now. And two, if you're purchasing these SPACs below the trust value and you're able to hold to maturity or till they come with the transaction, you have actually no risk of a permanent loss of capital. And that's something that's very, very important for how we like to run money and why the structure is so attractive. I guess the third option we didn't touch on, if they run out of time, they spend 24 months, they don't come with the transaction, the trust account is liquidated, returned pro rata to shareholders. So that's going to be, again, $10 plus some sort of accrued interest. So one of the trades that we wanted to highlight, I guess I'm not doing great with the slides here, but anyways, that's a little overview of it. So one of the trades we wanted to highlight is TPG Pace Energy. So this is a trade that we've had up until very recently in the portfolio. So TPG, a very, very well-known private equity firm, partnered with Steve Chazen, who's the former CEO of Occidental Petroleum. He really built Oxy to what it is today. It's a $60 billion plus energy company. So very, very highly regarded management team in the energy space, certainly. So in May, they came in, they raised $650 million, issued a unit at $10. The unit consisted of one share and 1/3 of a warrant. But as you can see, the common share post-IPO actually almost always trades at a discount. So the unit comes out at 10, the unit splits into a share and a warrant. So the common share will trade at some sort of discount to $10. We were able to purchase the common share between $9.70 and $9.75. So when you enter that trade, what you've effectively done is you've guaranteed yourself a 3% nominal rate of return in addition to what the treasuries are yielding inside of the trust account. Again, 3% nominal in addition to what's being earned in the trust account. And that trust account, again, is being backed by treasuries. So now, once you bought that 970, you wait to see it either, in the worst case scenario, they're going to take their whole 24 months and liquidate the trust account. That'll be equivalent to about 1030 if they were to take 24 months after the accrued interest. Or B, they come with an acquisition earlier, which is what happened. So in late March, they entered into an agreement with Intervest to carve out some of their South Texas assets in just under $2.7 billion transaction. They named the pro forma company Magnolia Energy. But what ended up happening, as you can see in late March, is the stock actually jumped from 970 up to 1030. That's a pretty good outcome in the SPAC universe. So we look to sell at 1030, take our 6% nominal that we earned in just under a year and move on and reinvest that capital. But that's, I guess, it's a very good example of what can happen in the SPAC market and how we try to invest in the SPAC market. And that's really recreating treasuries at a discount to treasuries or higher yielding treasuries. So in this scenario, we guaranteed ourselves a 3% return above treasuries, ended up making 6%, and instead of taking 24 months, it took 12 months. But again, the attraction to the product is during this whole period, there was no risk of a permanent loss of capital. So over time, this strategy has served us pretty well. We've returned just under 14% annualized over a 5-year period. Again, 3 drawdowns over that time period, with the max drawdown being 59 basis points. So we think we found a nice niche in the market, certainly to produce a very low volatility, low correlated, steady return for our investors. And again, with how we've invested the capital and our focus on the SPAC product, we think it's very, very conservatively invested in the case of a downturn. At the end of the day, certainly in SPACs, what you're investing in is treasuries. It's just they return with this structure, it returns higher than what a treasury would normally return. So we think we're very, very well protected in the case of a downturn. Very happy to take some questions. I know it's a bit of a niche product. I'm not sure how familiar we are with SPACs, but happy to take some questions.
Yeah. So could you give an example of a SPAC destroying value after announcing its 12-month transaction?
Yeah. I mean, I think every single Canadian SPAC has destroyed a tremendous amount of value. Certainly, now they're a difficult structure for management teams to actually create value, because in the SPAC structure, the attraction for a management team is they issue themselves a 20% promote. So they raise $100 million, they're going to get a $20 million promote on that $100 million. So they have to go find a transaction that creates value above and beyond $120 million for it to trade above $10. Now, there's many ways you can do it, and there's been a lot of success stories in the States. So Silver One was a US listed SPAC backed by Riverstone. Their transaction traded immediately to $18. Gore's sponsored a SPAC, and they IPO'd Twinkies into their SPAC. That traded right to $13. So there's been some very, very good outcomes. There's also been some very, very poor outcomes. I'm not sure how familiar we are with the Acast outcome in Canada. Trilogy was another one, which was a LineVest one. So those were very, very bad outcomes, but at the end of the day, we don't really care what the outcome is post-qualifying transaction. We're never going to own an operating company. The risk profile dramatically changes from having a put at $10 no matter what to having no put. It can go to $1.50 or $2 wherever Cast is. So we'll never own a SPAC post the completion of the transaction. Okay, thank you.